Good morning and welcome to On the Money right here on WDBO AM 580, always streaming inside your WDBO app. This is your chance to hop on the air, hop right in the middle of a conversation or start your very own conversation with something that may be on your mind here in the financial advising world. As you know, the Dow goes up and down. All we can do is plan for the best, and we got two of the best certified financial planners on the air with us today. We got Joe Bert and Dillon Little from the team at Certified Financial Group. If you want to call in, 844-580-9326. You can call in like people have for decades here on WDBO during this hour, as this show is the only show of its kind. It's a live participatory financial call-in program. So you are part of the show, and so we just love talking to you, and I love sitting on the sidelines and hear these experts solve everybody's everyday problems to help them be just a little bit more secure when that time of life comes. Joe, Dillon, take it away.
Josh, good to be with you. As you said in the intro, Dillon and I are here to take calls from our listeners this morning. Anything that might be on your mind regarding your personal finances, things you've been struggling with about your IRAs, 401ks, long-term health care, mutual funds, ETFs, insurance, reverse mortgages, all that and more that Dillon and I and the 15 other certified financial planners deal with day in and day out, providing retirement planning and investment management for a fee. But on Saturday morning, we are here for you absolutely free. And as you said in the intro, Josh, this is the only this is the only show on Saturday mornings and Sunday mornings, financial show that is not a recorded infomercial. We are here for you live, taking questions from you off the air and trying to provide you a little insight on what's going on in the financial world, financial planning world, the world of economics, and all that stuff that swirls around us every day, day in and day out. So if there's anything on your mind, questions you've been trying to figure out, things your brother-in-law may have told you that just don't sound quite right, the good news for you is the lines are absolutely wide open. You can be in the front of the line by picking up the phone and dialing these magic numbers.
The numbers are 844-580-9326, 844-580-WDBO. You're also more than likely to send in your question via the open mic inside the WDBO app. The topic of today's show: how could inflated oil prices affect economies?
Inflated oil prices. That's in the news, isn't it, Dillon?
It is.
Wow.
Yep, indeed. We're in a war. So obviously that's led to inflated oil prices. We've seen volatility in both stocks and bonds, both U.S. and abroad. So far, the U.S. market, measured by the S&P 500, is down about 5% year to date. So this was a pretty strong quarter, and we're finishing the quarter, down. I will say year to date, the volatility has been less than average. I've calculated over the last 45 years, measured by the S&P 500 index, the variation between the intra-year decline and where the S&P 500 ends up in the calendar year, the average variation between those two numbers is about 28%.
Uh-huh.
So in other words, if you were all stocks in an average year, you could expect to see your account, fluctuate by a valuation of 28%. So far, it's still early in the year, but we've seen less than average volatility.
Well, we'll see how that plays out.
Right. So again,
more to come.
This is all dependent on how long this conflict lasts. Vanguard is a pretty reputable company. They gave some insightful expectations this week of what they could see happening if oil prices stay elevated for various points of time. So their estimate is if oil were to stay over $100 a barrel for 2 quarters, it would only take about 20 basis points off of GDP growth.
And 20 basis points is 0.2%.
That's right.
Okay.
Exactly. Compared to Eurozone, the same duration, 2 quarters of oil prices over $100 a barrel would take about 100 basis points or 1% off of Eurozone GDP growth.
Uh-huh.
And you may say, why is it expected 5 times more for Europe than the U.S.? I mean, one, we're the largest oil producer in the world, and secondly, Europe is pretty dependent on foreign oil compared to the U.S.
There you go.
Secondly, inflation. I mean, we saw hot inflation reads for February before this conflict, because this conflict started at the end of February. So we would expect March to be again another hot inflation read whenever that data comes out. So again, for the same duration, 2 quarters of $100 a barrel, they expect that to add about 80 basis points to, or 80% of 1% to headline inflation for the year, and about 1% increased inflation abroad. So with inflated oil prices, obviously that trickles down into making everything else more expensive. As a test, I purchased airfare abroad about a month ago, and I checked the same exact route that I purchased last night, and the same exact plane route is over 25% higher
Jet
today
fuel.
than it was a month ago. Exactly.
Jet fuel, baby.
That's right. So again, Vanguard is estimating that in order for the U.S. to be in a recession, according to their estimates, that oil would have to be over $150 a barrel for the rest of the year.
Let's hope we don't see that.
Let's hope we don't see that. That'd be very high. You may say that doesn't seem like it would take much off of GDP if oil prices stay inflated. I think that's partially due to the expenditures on AI and AI infrastructures year to date. Interesting stat, between 4 major companies, Meta, Amazon, Facebook, and Google, or Alphabet, they've already committed to spending $440 billion on AI infrastructure, data centers, power plants, etc., for 2026.
For this year. This year alone.
year, yeah.
And that doesn't include Elon Musk with his projects.
Exactly.
Yeah.
Some estimates say they could spend up to $670 billion this year between those 4 companies. And if they were to commit to that amount of capital expenditure, that would be the largest expansion of GDP growth in U.S. history, only second to the Louisiana Purchase.
So AI, at least in the short term, is propping up the economy,
Exactly.
even if things go sideways.
At least for this year.
The challenge, though, is finding the raw materials and the energy and the people to build it. Therein lies the problem.
Exactly.
To build the data centers.
Exactly.
So, but the good news is there's demand.
There it is.
If there's no demand, we're in trouble.
And whether those, how those companies turn this capital expenditure into a profit,
Right.
having an AI bill, if you will, that'll be the determination for, economic strength in the future. Another stat related to this is, again, the number I mentioned, if these 4 companies were to spend what they could expend on the capital expenditures related to AI this year, that would be larger than the development of the U.S. railroads in the entire decade of the 1850s.
Well, say that again.
So Amazon, Meta, Microsoft, and Google, if they were to spend their expected capital expenditure on AI infrastructure,
Which
in
is
2026,
460 billion, would you say?
currently it's 440 billion, but
440.
estimates could be up to 670 billion.
Mm-hmm.
If they were to spend that amount of money on AI infrastructure this year, that'd be a larger expansion of GDP than the development of U.S. railroads in the entire decade of the 1850s.
Wow. Just put that in perspective one
Exactly.
time. Wow. Wow.
So in other words, like you said, Joe, kind of propping up the economy, if you will. Just as we've seen volatility in stocks since the start of the conflict, we've also seen a lot of volatility in bonds. Bonds had a great year last year. A lot of interest rate hikes were kind of baked in. We expected to see that this year as well before the conflict. Vanguard was estimating that there would be 2 rate cuts this year. Obviously, there's a new Fed chair expected to come in May. I think the expectation was, especially if this was somebody that Trump wanted, that there would be more rate cuts, and bond prices would go up, because as we know, bond prices go up as interest rates go down. But with higher oil prices and higher inflation, that kind of puts the Fed in a hard place, right, Joe?
Yep.
So
That's a challenge right now.
exactly.
And that's what's affecting the price of gold, is that because interest rates are not going down and interest rates may go up and the dollar is strengthening, that's why the gold is falling through. In fact, gold has had its worst year. What's my notes say here? Worst week since 1980. Gold has had its worst week since 1980. And that's because of what's going on with interest rates, because of what's going on with potential inflation. So, and you would think that with the war out there, gold is a safe haven. People would be running toward gold, but it's actually just the opposite right now. So try to make sense of that one time. Yeah.
Exactly.
So we get the oil, not to be concerned unless it stays at $1.50 a barrel, right?
That's right.
For at least for a year, stays there for a year. Let's hope that doesn't happen. Hopefully we get the Strait of Hormuz opened up. Looks like we're making some progress there, little by little by little by little.
Right.
Dillon Little.
20%. Yeah, exactly. 20% of global oil production passes through the Strait of Hormuz. So there's currently hundreds of tankers in the Persian Gulf just kind of waiting for redirection or safe passage.
Right. Yeah, we had a email question float in there. Josh, you have that about why do
I can pull it up here. Yeah, again, we got open lines available if you want to call in to anybody joining the conversation. 844-580-9326. And so we got a couple of email questions. One on gold. Is that the one you're referring to?
No, I'm referring to the one about
Okay, I found the other one right here. The question is, if America imports less than 1% of Iranian oil, why did the price of gas go up so much? Would this not be an example of big oil companies gouging the American people, using news sources, lies, and politics to increase their profits?
that's a natural inclination, and we're talking about 1% consumption or 1% of imports coming to the United States, because oil is really a global commodity, and traders can move it between regions, and arbitrage keeps the price high. And when the price goes up, the raw material, the gas stations, in anticipation of that, raise their prices because they know higher prices are coming. And because gas stations work on such a low margin, they've got to protect those profits. And I feel your pain just like everybody else when you pull up to the gas pump. But because oil is a fungible commodity and is traded on the global market, that's what the prices are. So we're all impacted by what goes on all over the world with oil. So I'm not sure that answers your question, but that is what is going on. And we got a call there from Trish, wants to know about Social Security earnings. We'll get that after the break.
Yep, Trish, hang on through the break if you want to call in, 844-580-9326. We got more coming up next. You are listening to On the Money, where we're planning tomorrow
Today
with the Certified.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, you know, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream. CFG has been chosen once again as one of the top 100 financial advisory firms by CNBC out of nearly 40,000. And because they won't divulge the selection criteria, asked my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent, but we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know
Welcome back to On the Money here on WDBO AM 580, always streaming inside your very own WDBO app. This is your chance to hop on the air with two certified financial planners with the Certified Financial Group. We got Joe Bert and Dillon Little answering your questions live at 844-580-9326, 844-580-WDBO. Let's keep it over in Winter Park where Tish is calling in. Go ahead, Trish.
Hi, Trish. Good morning.
Hi, good morning, everyone. How are you?
Good. What's up?
I have, later this year, I'll be turning 62, and I'm going to go ahead and claim for my Social Security benefits. But I have read three different amounts, because I'm still working, three different amounts that you can earn up to certain this, that and the other thing, before they start reducing your Social Security. But I'd like to know, what is the true actual amount that you can earn before it affects your Social Security?
The 2026 limits are $24,480 until you reach. Okay, that's $24,480 before you have the offset of $1 for every two that you earn over that amount.
Okay.
And that number's indexed for inflation.
Right, and that number's indexed. So it went up a little bit this year. Go ahead.
Does that change each year?
Yes.
At the beginning of the year or at the end of the year?
At the beginning of the year, they announced that what the new number is. Last year, it was $23,400. So this year's $24,480.
Okay. Well, that's good to know. That was not an amount I came across. So thank you very much for that information.
That's why we are here. And so you want to be careful of that, because you're going to give back some of that Social Security. Now you get it back on the tail end. So if you were thinking, if you start earning more than that, you're not going to get the full benefit for what you thought you would have. So you got to be careful in that regard.
Understood.
Okay.
Thank you.
You're welcome, Trish. We appreciate the call. Have a great weekend.
Thank you, Trish.
You too. Thank you. Bye-bye.
Bye.
Thank you much, Trish. We got Les calling in. Les has got a question about how to handle with the market being down. Go ahead, Les. You're on the air.
Good morning, Les.
Hey, Les.
Morning. Can you hear me okay?
We can hear you. What's up?
Yeah, well, with the market being down a little bit right now, is this a good time to increase buying bonds or cut back on buying bonds?
Well, your bonds could or should be a part of your overall portfolio, certainly a balanced or moderate portfolio, right, Dylan?
That's right.
But you want to
Les, my question would be buying bonds in lieu of what? In lieu of stocks or in lieu of cash?
No, just increasing. I mean, I have adequate bond distribution or allocation or whatever, but I was just wondering, with the market being down, is if one is this a good time to buy more bonds, or hold off and wait for the market to come back before you buy bonds? What does the market? How does this current market affect the buying bond situation?
So I'm presuming you say that you're talking about how does the stock market affect?
Yes.
Okay.
Yes, exactly.
Well, generally they're inverse. In other words, when bonds go up, stocks go down, and vice versa. And the bonds have been holding up pretty well in this market, right, Dylan?
They have. I mean, we've seen some prices come down, but yields are still pretty good. There is less expectations for rate cuts this year than there was at the beginning of the year. But I would say, as an alternative to cash, you're probably still going to make more on bonds this year. Maybe not as much as we would have hoped before this conflict, but you're probably still going to make more on bonds this year than you would in a CD or a money market.
Right. Do you buy individual bonds, or are you buying through ETFs or funds? What are you doing there, Les?
And a mutual fund, PONAX.
And you're taking the income, or you're reinvesting?
I'm reinvesting.
Okay. So but if
But
you
I did not.
go ahead.
Go ahead.
Yeah,
I did, okay, your turn.
Bonds are, if what you're doing is you're reinvesting and you're buying more shares every time the price drops, and you're owning more and more shares. The amount of income that you're going to get is to be a function of the shares that you own. Holding bonds through an ETF is probably one of the most, probably a better way to do it than most people, unless you're a sophisticated bond investor and have a portfolio where you're trading the bonds and know what you're doing. We recommend to our clients that you have a professional manager doing that, and that's using an ETF, or in your case, a mutual fund. But I don't know if that's helping you in any way. But the point is what you want to have is bonds as a part of an overall diversified portfolio. It smooths out the volatility of what's going on in the stock market today. Our clients, even though the market is down, have not suffered as much simply because they have the cushion of a bond portfolio. Now, that being said, when the market turns around, they're not going to go up as much, but that's the price that you pay for having a little bit more moderation or stability in your overall portfolio. I hear the bumper music. Josh, take it away.
Thank you so much, Les, for calling in. If you want to call in with a question of your own after this here news, weather, and traffic break, Michelle's going to bring us the news here in just a few seconds. If you want to join the conversation, we got open lines available to you at 844-580-9326, 844-580 WDBO. You're listening to On the Money, where we're planning tomorrow
Today.
with the Certified.
Once again, it's one of the top 100 financial advisory firms by CNBC out of nearly 40,000. And because they won't divulge the selection criteria, ask my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent, but we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online.
You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with, Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health.
Perfect.
Yep.
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. We got two certified financial planners from the Certified Financial Group here to answer any question you may have. We got Dillon Little and Joe Bert available to you, the WDBO listener, at 844-580-9326, 844-580-WDBO. You can also send in your open mic question using the free WDBO app. Just before the break, Les asked Dillon and Joe a question about, just diversifying when the market's down a little bit. And we have a little more context for that answer, guys.
Go ahead, Dillon.
I was just going to add something about diversification, pretty much on the stock side. There's 11 stock sectors, and the important thing is to just be pretty much at market weight or around market weight amongst all those stock sectors. You don't want to bet the farm on one stock sector or one, industry. It's very hard to predict. So, energy stocks are up year to date, but energy only makes up 3 to 5% of the overall market. So while everything's down and energy is up, it's just hard to time these things, right?
It's impossible.
Right.
So what you want to have is diversification, and then you want to have the best money managers working in those specific areas and trying to get the most out of their portfolio. But you never know what's going to be in vogue at any particular point in time as the world turns and things change. But diversification keeps you from, it doesn't mean that you won't get a cold, but you won't die of pneumonia if you're diversified. And that's what we try to do for our clients, is determine what the rate of return that you need to get you to and through your retirement years, how to build a portfolio around that with the highest degree of probability and the lowest amount of volatility. And that's what it's all about. And it's not betting, as you said, betting your ranch on one particular sector, which is a natural thing to do. You see what's good at the moment, and you see you're going to latch onto that thing only to be disappointed. Like, how many people saw what gold did last year? And now, as I said earlier in the program, that gold is at its worst week since 1980.
Exactly.
So if you jumped in January, you may have been
high.
Yes, you may have been a little disappointed.
Yes, a couple of questions we've had from clients this week is on defense stocks. You think naturally, okay, there's a war going on,
right?
I should buy defense stocks, right? Well, year to date, they're actually still up, but since the start of this conflict, a lot of defense stocks are actually pretty much flat.
Yeah,
which
interesting.
Naturally, you wouldn't think that.
Yep, but that's why the money managers that have to sort through that stuff. You have to look at who's got what products in the pipeline, what their labor situation is, what their raw material situation is. Can they deliver? Are they getting the contracts? And that's what you call due diligence. That's what the money managers that the funds and ETFs pay tens of millions of dollars every year to do that analysis. But you and me sitting behind a computer trying to figure it out, at best it's a wild guess. So our strength as Certified Financial Group is to find the best money managers that can do that. And through our rigorous approach using the Center for Fiduciary Studies and the FI 360 reports to do it, I think we do a pretty good job at that. So I saw we had a text question float in there. Josh, take it away.
We do. If you want to call in, open lines available to you. You can have a nice back and forth, get down to the nitty-gritty of your situation. Two certified financial planners, 844-580-9326. Or you can text in your question like Travis did during the week. Travis says, I have an inherited IRA that I inherited from my dad last year. I know that I have to deplete the account within 10 years. That sounds like a movie, of Brewster's Millions. I have to get rid of it in 10 days. Okay, sorry. Travis knows he has to deplete the account within 10 years, and there is a minimum amount that he has to take out each year. He plans on retiring in 2 years. Should he deplete the account sooner or later?
What do you think, Dillon?
Great question, Travis. This is an issue that's had a lot of confusion, a couple legislation changes, within the last decade. So the answer is it depends. But naturally, when you're still working, I think Travis said he's going to retire in 2 years. Your income is probably higher while you have earned income. So I would encourage Travis to take, the minimum amount that's required for those years, or maybe slightly above. But I would say to be careful, because something that we're seeing is, these accounts for most people, non-spouse beneficiaries, have to be depleted in 10 years. So they take the minimum, for several years. And then towards the end, they may have a 4 or 5 year window where this account has grown. We've had a good market, over the last few years. And they have kind of a tax bomb that's kind of concentrated in the last few years. What do you think, Joe?
Yeah, 100%. So everybody's situation is different in this particular case. Because he's working, you want to consider that. Look at what his other sources of income are. What's Medicare? How is that going to impact his Medicare premium? So that's what planning is. And as we talked about many times on this program, we are wealth managers, money managers, first and foremost, we're certified financial planners, trying to look at the big picture, analyzing all the variables that you have to look at, and then you make the right decision. And the interesting thing is you make that right decision today based on the facts today, but those facts change. And this is what our clients look to us to keep them informed about as their situation changes. We're always that resource. And we always encourage our clients to keep in touch when things change in your life, whether good or bad, and how it impacts your financial life. And thanks to the sophisticated software that we have today, we can model those what-if scenarios very quickly for you and get them right out to you to show you the impact of that. So hope that answers your question. We got another one there, Josh?
We sure do. Patrick asks, Patrick says, a friend told me that because I'm considered highly compensated, I will have to make Roth contributions to my 401k this year. Is that true?
Yes, it is true.
Starting this year. Yeah,
Yep.
that was a provision in Secure 2.0 that's starting in 2026. If you made over $150,000 last year, if you do catch-up contributions, that means if you're over 50 and you get an additional, retirement plan contribution, that will have to be designated to a Roth account. Roth, 403B, Roth 401k, so forth. So something important to note is that only applies to an individual. So it doesn't matter if you're filing single or married filing jointly. One spouse earns $200,000, one spouse earns $50,000. It's only the person who is earning $150,000 in the prior year is subject to the catch-up contributions being designated to Roth.
So what you're saying, you don't look at your joint income, you just look at the income
Exactly.
for the individual. So once again,
and
when
that
you,
number is supposed to be indexed for inflation as well going forward.
so once again, when you put it in the Roth, you lose the tax deduction that you would have in a regular 401k. So they're saying, okay, you're going to pay some tax now, but you get to put it in a Roth and it'll compound for you tax-free. And then when you retire, you roll that into a Roth IRA and you're on your way.
Exactly.
So that was a little bit of a hiccup there. And I'm sure all the plans that are out there, I know we manage several plans here at our company for companies, and all the plans have been adjusted to accommodate that. So that's one of the recent tax law changes that we have to stay on top of. It's a never-ending battle.
It changes quite frequently. And one strategy that I like, and again, depends on your situation, is if, say you have, one spouse earning more than another, higher earning spouse is contributing the maximum to their 401k, and let's say that the lower earning spouse is not contributing the maximum. What you could do in order to, boost pre-tax savings and lower your taxable income in the current year is have the higher earning spouse contribute a little bit less so they're not subject to the Roth catch-up, and have the lower earning spouse, if you can afford to, increase their pre-tax contributions. So overall, you may be getting a higher pre-tax.
That's a terrific idea, because it, once again, is based on that individual's income, not the
Exactly.
joint income for the family. So that's a great idea. I like that very much. Good choice. Good idea. All right. I see another text question floated in there, Josh.
Ideas flying around like gold around here, so maybe we can help Bob out with some more gold. Bob says, my wife and I are both over 65 and will receive a higher standard deduction thanks to OBBB. Should we consider converting more of our pre-tax IRA assets to Roth this year?
Potentially.
Maybe.
It depends on your individual tax situation, your income needs. Last year was the first year of the additional senior deduction, which is $6,000 per person for married filing jointly. That begins to phase out at $150,000, I believe, and $75,000 for single filers. So that kind of gives you, you're under that income threshold, another $12,000 wiggle room to do Roth conversions. Let's say one thing, periods of volatility like this, depending on how far it goes, it may make more sense to do Roth conversions in periods of volatility. What I mean by that is while markets are down, you can convert more shares to Roth, that will eventually recover.
Yeah.
Tax-free in the Roth account.
Yeah, say that again, because I think that may have slipped by some people. What you're saying is when share prices are down, if you're going to do a Roth conversion, that's the time to do it.
Exactly. Yeah. Sometimes, you can't time the market.
No.
Sometimes a bird in the hand is better than two in the bush. If the market's volatile and you're considering a Roth conversion, maybe just be the time to do it versus thinking, okay, well, maybe it'll go down more. But in the case of Bob, yes, he would have an extra $12,000 deduction if his income is under $150,000.
Right.
So that may, if that's something he's interested in, and he's still in a low bracket, that does give him a little bit of wiggle room to do extra Roth conversions.
So, Bob, if you're listening, once again, that's what Dillon and I and the 15 other certified financial planners do, working with our clients, trying to figure that stuff out to save you some tax money down the road. If you want more information about that, go to our website. That's financialgroup.com. That's financialgroup.com, and you can get more information about what we do and how we do it. So I saw another text question floated in there, Josh.
We sure did. We got one from Nadine.
Nadine.
A long one, so I'll start taking notes here now. Nadine needs to replace her roof this year, and she's been quoted that it will cost $50,000. Nadine is single, not wanting to collect Social Security, not collecting Social Security, and she's got $500K in her IRA, $700K in her brokerage account, and $300K in her Roth.
Nadine.
Which account? Oh, yeah. So
honey, is that you? Remember that song? Remember that song?
It kind of rings a bell.
Yeah.
Yep. It kind of rings a bell there. I wonder if she's named after that song.
It could be.
So Nadine essentially wants to know which account should she pull funds from to pay for that roof. She's got $500 in her IRA, $700 in a brokerage account, and $300 in Roth.
And does she say how old she is?
She did not specify. No.
Okay.
She did say she's not collecting Social Security, so maybe near that age.
All right, so she has three accounts: a traditional IRA, a Roth, and a brokerage account. She's got to spend $50,000 on a roof, right? That's the question.
That's right. Yep. She was quoted at $50K.
So
she's
where to
single,
pull, where to
She
pull
wanted
them?
say
And
she
she's
was-
single.
Yep.
What do you think, Dillon?
I would say it depends. So I'm not sure if we specified if Nadine is still working or not, but she's not collecting Social Security. So depending on her income, this is where I think we add a lot of value, is on the planning side. I mean, big ticket item budget planning is super important for both pre-retirees and retirees, because you don't want to pull money from a certain type of account, realize a large gain, or pull it from an IRA, and next year you have a huge tax surprise. So in the case of Nadine, we would need to know, what is her current income sources, if any, and, what is the expected, income, interest, and dividends, capital gains realized in her brokerage account. And we would like to keep Nadine in a low bracket if possible. So if the roof is $50,000, we would need to pull money from, maybe the IRA, the brokerage account, and the Roth, a combination of all three accounts in order to keep her in a low bracket. So that's why big ticket item planning and tax planning is a huge, huge part of what we do for our clients.
There you go. All right, hear the bumper music. Josh, take it away.
Again, if you want to call in, we got one more segment to get your questions live on the air. 844-580-9326, 844-580-WDBO. You're listening to On the Money, where we're planning tomorrow
today
with the Certified.
$40 years ago, I had a dream. CFG has been chosen once again as one of the top 100 financial advisory firms by CNBC out of nearly 40,000. And because they won't divulge the selection criteria, asked my colleagues what they thought.
Maybe it's because our history dates back almost 50 years.
Could be because we're independent, but we custody with national firms like Fidelity and others.
17 CFP professionals under one roof.
Or it could be because we're CFEX certified.
And a real person answers the phone.
In any case, we're proud to have been selected. So if you're looking for financial planning or investment advice for a fee, look us up online. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal, ooh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak, just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit, it's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy, your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it?
Welcome back to On the Money here on WDBO AM 580, always streaming inside your WDBO app. Wrapping up another great episode, hosted to you by two certified financial planners from the Certified Financial Group by the names of Joe Bert and Dillon Little. And if you want to go out to their futuristic state-of-the-art workshops for maybe some lessons on how to best prepare for your 4 stages of retirement, well, Dave Balakrishnan is going to be there helping you here in just a few weeks. Isn't that right, guys?
Yep, 2 weeks from today at our offices here in Altamont Springs from 10 to 11:30. Dave Bella-Christian will be talking about planning through the 4 stages of retirement. Everything you need to know about taking money out of your IRA or 401k or 403b or 457. Talk about Secure Act 2.0, just some of the things that Dillon and I talked about today, things that you need to be made aware of so you don't step in it, as they say. So once again, that is absolutely free. People say, well, why do you do this, Joe? We do it for basically 2 reasons. Number one, to protect you from hopefully protect you from becoming a financial casualty. And secondly, to introduce you to what Dillon and I and the 15 other certified financial planners have done for almost 50 years for our clients here in Central Florida, providing retirement planning and investment management for a fee. This way, whether you need that service now or sometime in the future, you'll give us an opportunity to earn your business. So once again, go to our website. That is financialgroup.com. Financialgroup.com. You go to the pull-down menu for workshops, and you can make your reservation right there. And the other thing I want to tell our listeners about, remind our listeners about, a very popular feature that many of our listeners have used over the years, and that's Score My Funds. It's an opportunity for you to get an objective look at the mutual funds or ETFs that you own in your brokerage account or in your IRA or 401k. All you do is you go to scoremyfunds.com. That's scoremyfunds.com, and you'll go to a page that will ask you the tickers for your mutual funds or ETFs. If you don't know it, there is a pull-down menu. You put in the name, it'll give you the ticker. You insert that right there, and all you have to do is send that to us via the internet, and within 48 hours, 24 hours in some cases, we will send you a detailed report that is a score from FI360. The Center for Fiduciary Studies is what we use to score and rank all the investments that we offer to our clients. You want to talk about FI360 a little bit, Dillon?
Yeah, so it's a peer-to-peer comparison, so apples to apples only. So, for example, large growth funds are compared to large growth funds. International funds are compared to international funds, small cap funds to small cap funds, and so forth. So it looks at 11 criteria, such as 1 year, 3 year, 5 year returns. How expensive is your fund compared to those in the peer group? How long has the manager been there? Risk-adjusted returns. So it's a good way to see if your fund stacks up against its brothers and sisters, if you will.
And it's totally objective. We provide that for you absolutely free. That's scoremyfunds.com. Scoremyfunds.com. And I hear the bumper music. Josh, take it away.
Thank you so much. And thank you so much, Joe and Dillon, for wrapping up another great edition of On the Money. If you want to call in, we got a number for you available Monday to Friday, 407-869-9800, a building filled with certified financial planners. And again, thank you so much for listening to On the Money, where we're planning tomorrow
Today
with the certified financial